morning, Anahi.
Good morning.
What are we chatting about this week?
We are talking about the different types of advisors and when each is appropriate.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so we're talking about ourselves.
Yes.
I think we are the only type of advisor, and we're always appropriate.
That's it.
That's
Nothing
it.
else.
Perfect. Easy conversation.
Well, I kind of want to touch on. So most people don't wake up one day and just magically understand what is the best way to manage their finances. A lot of people, like me, and I can talk for a lot of people, we learn about money by making mistakes. Taking advice from close friends and family, or simply just Googling quick question here and there. What a lot of people don't know is that there are many types of financial help available, like a lot, like for every single thing that you could possibly think of. So some people prefer full guidance, while others just want like a little push, a little sense of direction. So today, I wanted to talk more about the different types of financial advisors people can work with, when they make sense, and how someone can figure out when and which one is the best fit for them.
Okay. I mean, I agree. I think a really good place to start this conversation is just to talk about sort of the academic view of why people seek financial help in general.
Mm-hmm.
So in particular, the primary theory on this is literally called financial help seeking theory.
Mm-hmm.
And it really just suggests that most people don't seek financial help until there is a stressor in their life that becomes unmanageable,
mm-hmm.
and that then seeking financial help is one of many ways they may attempt to assuage or resolve that stress.
Mm-hmm.
Think of it the same as be having some sort of injury or some sort of discomfort, right? If it's a little discomfort, you just go about your life. If it's a little more discomfort, maybe you take ibuprofen, Tylenol, something like that. But if it gets really bad or it's really affecting your life, you end up going to see some sort of medical provider.
Mm-hmm.
It could be a doctor, chiropractor, acupuncturist, physical therapist, massage therapist, depends on the nature of your problem, but you seek out somebody to help you resolve your specific conditions. That's sort of the basic premise and predicate of how or why somebody is ultimately going to say, or rather go from saying, I don't need help with my finances, to I have some sort of financial stressor or problem and I want help with that.
Mm-hmm. So, and then I feel like this can also be a thing where people have that one problem and then they either want to solve it now or not even need but have to. For example, like a loan, like a school loan that they're trying to pay off before they buy a house, or something that can just be long-term. So just having a long-term goal, maybe it's not something that they have to accomplish, but it's a goal that they have in the back of their mind. Maybe having, or like reaching a certain amount in their savings account, or having a certain amount for their grandkids after they pass away. So, there's a couple scenarios that we can talk about, and then I kind of want to hear how each would fit into the scenario, like when a fee-only advisor could be helpful, when a commission-only be helpful, and just go through like the scenarios for each and see how it can be helpful for each scenario.
Sure.
Yeah,
I think there's sort of an easy framework to think about as we go through this conversation, which is there are people who have one acute specific problem that they're seeking help with. And then there are people who sort of say, I feel like I've got a lot of financial problems. And when I say problems, it doesn't mean that you're like in sort of some sort of financial distress. Sometimes it's just, hey, I feel like I've got a lot of cash lying around. My kids are getting a little bit older. I'm getting a little bit older. I don't feel like I've just got like a good handle on my finances overall. And it doesn't mean that they are poor or not able to pay their bills. Some people have a lot of money who still feel like, I just don't feel like I have a good handle on this. I don't know that I'm doing this really well. So, the difference between somebody who has a specific problem they want fixed versus sort of a general assistance need, and then a self-perception, and it can be accurate or inaccurate, but a self-perception that they need short-term, kind of one-time incremental a la carte help, or a perception that they're going to need lots of ongoing support over the long term. And both can be true and both can be false, depending on who it is and who we're talking about and what their needs actually are.
So let's talk specifically like one that you mentioned. So somebody who has a lot of cash in hand. Maybe it was settlements, maybe it was inheritance that was passed to them, and they don't know what to do with that huge amount of money. What are their options?
Well, I mean, I think the question here becomes, do they have the time, energy, interest, and knowledge to put that money to its most efficient and best use, right? So, I want to be careful about your examples here. You talk like an inheritance versus somebody who's been like in an accident and had a settlement.
Okay.
Those are sort of different setups. I don't want to get too into the weeds there, right?
Okay.
But somebody who just got $1 million from grandma versus somebody who was in a really bad car accident, has injuries and can't work anymore and so on, is going to have a different approach to this type of problem. But, taking that circumstance, taking that situation and saying, hey, you are an individual who has enough money that they need to do something more productive with it. It really depends on what are your goals, right? Do you have an objective that you want to start using this money in the short term, and you're going to buy a house, buy a car, pay off your student loans, move across the country, pursue a new career? Like, it really depends on the objectives that you have. If you have some kind of immediate need, you may not need financial help. Like, you might want some financial help, but you may find that the abundance or the bulk of your objectives are so short term that professional financial help is not going to do much for you, because the answer is going to be, well, spend the money, put the money in a safe spot for 3 months, and then spend the money, and so on. So I think in that scenario, then, if it's the case where somebody says, like, okay, this is an abundance, a windfall that I've received, and I need this to work for me long term. I need this to help me retire, help me become financially independent. I need to live on this money for a long time. Then I think that's a case where somebody probably is going to need a fairly comprehensive relationship and a longer term relationship. And I say that in the context that if they were to just go to somebody and get like a one-time thing, like, here's what you should just put your money into, you're good to go forth, do great things. They may not have the knowledge, skill set, or awareness to understand when a change is needed in the future, and that could lead them into some problems. So I think for that type of person, an ongoing relationship is going to make more sense. And the reason that they probably need a more comprehensive relationship instead of just a, hey, help me invest the money relationship, is that type of plan is going to be very sensitive to changes over time. And that could be changes in lifestyle, expenses, health, family situation, taxes, all sorts of things. And so just saying like, hey, we're going to set up a portfolio and we're never going to talk about anything else for the rest of our lives, probably isn't going to be a good long-term fit for that person, because the portfolio might do great, they might make lots of money, but it may not be addressing other issues and other areas of their financial life.
Like, for somebody who doesn't have a lot of knowledge in the back of their head, or just have been learning this over time, if they come across like somebody who's just trying to sell them something or trying to sell them a product, it becomes a high risk. It's something that people are going to try to look forward to, because you have all of that money. And since you don't know what's happening, I think it's riskier to have somebody sweet talk your ear off and try to convince them to do certain things. So I think I would kind of agree. I would say that having somebody long term in that scenario where somebody can help you along the way to give you a little sense of direction and what you can do with that types of things, and helps you accomplish the goals as well. Like, it's for your best interest.
And I think it's an interesting thing, because you bring up, being cautious around somebody trying to like sweet talk you into buying a product or something. Depending on the person and their situation, a product could be the right solution for them. It could actually be the right outcome. The question then is, do you want to rely sort of on that old analogy about, to a carpenter whose only tool is a hammer, all problems look like nails? Yeah. Do you want to have the assessment of what's appropriate for you made by a carpenter with a hammer? Or do you want to have it made by an architect who can look at everything and make a holistic evaluation of your needs and of your situation to determine that, hey, it turns out that particular tool is the right decision for you? I think there's an expeditious way, right? If it turns out that was the right choice for you, sure, you'd save a lot of time and energy just going to the place where you're going to get that solution put into place. But you're taking a pretty big gamble that that's going to be the right outcome for you. And when we say that, to give people some flavor around what those types of tools might be, there are plenty of people out there where the only way that they give financial advice or give people financial assistance is they sell them annuities or they sell them life insurance. There's nothing wrong with annuities. There's nothing wrong with life insurance. It's just a question here about, if you have this windfall in your life, do you want to put all of your money into a single product or a single thing because you are getting advice from somebody who only can give you advice to purchase that type of thing, versus working with somebody who's going to be a lot more agnostic to what you do ultimately with it. And in turn, right, if the recommendation from that more comprehensive, more impartial planner is you need life insurance, you need an annuity or something, then the person who does nothing but sell life insurance or nothing but sell annuities can then be a terrific resource and a great partner where you want a specialist who does nothing but work with those types of products that you can then lean on their knowledge to pick the best one of those for you.
I feel like also age has a lot to do with this situation as well, because I mean, if you're in your early 20s and you all of a sudden receive like a huge amount of money, I think it's very different. You would do very different things if you were earlier in your 20s than if you were like in your 40s, 50s. So yeah, it's interesting to see all the views and how different outcomes they can be. So the next one we can maybe touch on, and I talked about this earlier. Somebody who has like a school loan and they are trying to purchase a house.
Yeah, I think that's to use our framework of the short, long-term, single-issue, multi-issue, that probably works well in a single-issue, short-term engagement, particularly because if we're trying to buy a house, we're probably trying to do that in a fairly tight time frame, right? This year, next year, the next 3 to 5 years, something like that. And in turn, student loans, they can go on for a long time, but at least traditional federal, subsidized student loans and so on typically are going to have anywhere from like a 10 to a 25-year time frame. That could be the rest of your life. Hopefully it's not. But all that to say, it's a fairly acute, specific planning objective. And so a case like that could be really well served on a project basis or an hourly basis, where you go to a specialist in student loan or student finance planning, and they are able to kind of build you a spreadsheet and tell you what type of loan repayment program to use, whether you're better off paying it down versus just going for forgiveness, whether you could be eligible for public loan service forgiveness. Or from that, right, is it going to be feasible, right? You say like, my problem, right, my pain point is I have these student loans and I think they're going to hurt me or prevent me from buying a house. Sure. But there's also the objective of buying a house. And I think a financial planner on a project basis or an hourly basis can also probably help you assess, depending on the best approach for the student loan problem, where it saves you the most money over a lifetime and that's more financially optimal. How does that align to how soon you're buying that house and what kind of house you're buying and how much you're spending on it? Because the recommendation could be, try to get your loans paid off super duper fast, so that way you have a better debt to income ratio that makes you more qualified to buy a more expensive home. But they might also be able to save you from making the mistake of buying too much home, regardless of what you do with the student loans, because there's a big difference between what a bank will lend you and what you can actually afford.
And then, so with these projects that you mentioned, where it can be like a one-time thing, how do they assess for like risk? What if something goes wrong in the time that they projected the project for?
I think there's a cost-benefit analysis. It's sort of a break-even decision here. Imagine a hypothetical spectrum where you can get financial help for free, and I say that in quote marks here, but you can talk to your friends, your family, your neighbors, your brother-in-law who works for a financial firm or something, and they won't charge you, and they'll kind of tell you what they think you should do. And imagine you could pay up to $10,000 for super-duper robust, complicated advice. I think there's a risk-reward balance here where when we think about the hourly engagement or the project engagement, we're probably out a couple $100, maybe $1,000 to $2,000 for this type of engagement. And so that's a cost. And then we have to say, okay, if my objective is going to happen in the next 2 years, big risks could be losing my job. It could be a death in the family. It could be a need to relocate. Now where I wanted to buy a home is much more expensive, based on where I have to relocate to. It could be getting married, getting divorced, having children. Like there's plenty of risk factors here. But I think you have to sort of do a discount rate calculation and say, how much is it going to cost me to plan to hedge any and all possible risks versus how harmful the effect could be? Because sometimes the risk is just an immediate showstopper, right? Yeah. I was going to buy a house and then I lost my job. Guess what? I'm not buying a house. So long as I don't have a job. I don't need a plan. I don't need to pay a planner for more hours or a larger scope of projects to help me hedge that risk. And you could get into like, well, what if the stock market tanks or something like that? I think depending on the duration of the plan, you're probably not that exposed to that risk because you're probably going to have been advised to use some money market funds or CDs or something to preserve your purchasing power during this short time period versus having all your money in the S&P 500 and, it makes you 30% one year and then it loses 40% the next year. So all that to say, I think it's fine. You can acknowledge that there are risks you're not planning for or not taking into account, and you're better off not paying to take them into account and just accepting that those are risks you're not really prepared to mitigate. But if it's a risk that you can't afford, like you have to buy this house, within the next year, you must do it. There's no other opportunity. There's no other chance. Yeah. Then it might make more sense to try to hedge those risks as much as possible. But I think then again, because of the time frame, because of the costs, it's hard to find a valuable break even on overpaying to really hedge all those risks in such a short term, finite engagement.
Would your answer still be the same if it was somebody who couldn't pay their school loans off as soon or as short term?
Well, I think that's the reality for a lot of people, right? The nice thing about having your student loans paid off, again, is that it improves your debt-to-income ratio. Yeah. It's going to be preferable for underwriting. It's going to be preferable for affordability. But, if you went to law school, if you went to medical school, if you, went to school out of state and then got a master's out of state, it's not hard to end up in a world where you have $100,000, $200,000 of student loans. And that's not going to be practical to just aggressively pay down super fast in the next 12 to 24 months. And so then the plan there is, look, let's optimize your debt to income ratio where we're minimizing your payments as much as possible while still getting to forgiveness or paying off at some point so that we can then still afford to purchase a home, not just in underwriting lending terms, but just in practical affordability terms.
Being able to afford it. What on the complete opposite side of the spectrum? It's somebody who is in their 30s. They have a great job. It's adequate for what they need in their family. They just need a little bit of guidance, and they just need affirmation along the way that what they're doing is okay. They've been doing it on their own for the time being before they ask for help, but now they want to know that their future is set.
I think it's an interesting scenario because we see this person all the time, or the example of this person all the time. It is very common for us to see I'll give a hypothetical case study here, right? It's very common for us to see a family where one person's an engineer or software developer. They work in aerospace or something here in Boulder County. Their spouse works for Boulder Valley School District or St. Vrain Valley School District. And they come in and they sort of have this initial view of we're doing fine, we're doing okay, but we thought we'd get a checkup. And we're going to get a checkup, and then we'll be good to go kind of for the duration of our lives, and maybe we'll come get a checkup again in 10, 20 years. That's a very common profile of a person that we meet with and work with. It's interesting then to see how many of them come in with this sort of, hey, we'll do the 1 year engagement and then we're set, and how many of them are still working with us, right? Probably about 9 out of 10 of the people who come in saying they want a checkup keep working with us after the initial checkup. I do think that type of person is going to be naturally attracted to a project-based engagement where they don't have a long-term obligation or an ongoing obligation. But at the same time, it's something where I think it's very easy to feel healthy, look healthy, right, in a financial sense, and then go to a professional who runs the test and does the analysis and says, look, there's lots of work to be done here. I know you just kind of wanted us to tell you how you're doing, and I'm telling you that you're doing okay, but you're not doing great. And you now need to make a decision about whether you want to continue and keep working on this, or whether you're going to kind of bury your head in the sand about it. And I think that's something where a lot of people come looking for an hourly engagement or a project engagement, and then there's this weird push-pull in the relationship where it's look, you came to me, you wanted me to tell you what was going on. I know you're expecting good news, but I don't have good news. Yeah. And the push-pull can then make that feel like a bit of a sales tactic where it's oh gosh, you came in, everything's wrong, everything's bad, you got to work with us long-term. And it's look, that's not really the intent. I am a fiduciary. I have a duty of loyalty and a duty of care to tell you the truth. And so when you come in with a suboptimal set of conditions, I'm going to have to tell you that that's what it is and that it's going to take time and effort, energy. You then have to make a conscious decision about whether you want to continue to work on that with me, or if you want to take the awareness of that and try to deal with it on your own. again, I think there's a right fit out there for everybody, and I don't think there's a perfect, you have to have a long-term relationship or you should only have a project relationship. But I think there's a world where sometimes you start on a long-term relationship and a couple years into it, things are going great and you go, I don't know that I need to do this anymore. And it's wonderful. And there's times where people come in saying, I want a finite relationship. And the prognosis really is, hey, that's not going to serve you well. And now you need to make a decision about going beyond what you were originally looking for to ensure that your needs are met.
So how do you see, what are some of the characteristics, I guess, or things that you see happen when somebody comes from another advisor, like a fee-based, somebody who also sell them stuff? What are the types of things that you see when they're like transitioning over?
I try to be really generous in this particular context because every advisor I've ever met, like I've never met an advisor where I was like, wow, you are, pardon my French, a total piece of shit.
Yeah.
I've never really met that person. What I have seen is the byproduct of incentives. Where, if somebody comes to us from a Northwestern Mutual or a New York Life, I am all but positive that the person coming to us is going to have a whole life insurance policy from those companies. Whether they need it or not now, it may not be the relevant question. Maybe they needed it when they first got it. Maybe they got it 20 years ago. So again, I try to be generous with that, but I generally anticipate or expect that I'm going to see what was incentivized at that company for this client. So if it's an insurance company, we're going to see that insurance company's products. If they came from a wirehouse or a brokerage firm, we're going to see some complex financial investments, or we're going to see extra lines of credit or bank accounts or other financial products that were offered by the larger organization. And so that is something where functionally, when somebody comes from another firm, they're going to reflect the philosophy, policy, and incentives of that firm. And that can be good or bad, case by case. So in that, I typically expect that they will have gotten some degree of advice, but they are coming to us because they feel underserved in some way, shape, or form. And that might be because they talked to this broker or this agent 20 years ago and got some products in place and they have never talked since. And now they feel like they have a different set of problems that broker or agent hasn't been helping them solve for the last 20 years. Or sometimes it's very direct. We brought on the largest relationship we brought on last year was somebody who has worked with a particular advisor for like 30 years.
Wow.
And they literally came to us because they said, this advisor never answers the phone when I call and never calls me back and never answers my emails. And then when we started working on their case, we found out, essentially, keeping it general here, this advisor was just sort of asleep at the wheel. They bought them 2 or 3 specific financial products, put their money in one particular investment account, and there was essentially no activity, transaction history, or anything for the past decade, essentially. And this person had still built wealth and made money, but this advisor, for whatever reason, didn't have a business model, wasn't appropriately incentivized to give them ongoing support. And so they thought they had that relationship when, in fact, they had really just worked with somebody who sold them some financial products and said, you're good to go. And there was a miscommunication there and a difference of expectations.
Yeah. So this kind of leads me on to the next thing that I wanted to talk about. So, well, not the next thing, but just looking closer into the different types of advice. So there's commission only, fee based, and then fee only, and like the little subsection of advice only. Just wanted to take a closer look into each, kind of look into the compensation side of each, and who looks out most for the clients, I guess, who is more for the clients, or when is it more appropriate for them to act for the interest of the client, if that makes sense.
Sure. I think proportionality is helpful here. So as we talk about this, it's easy to sort of hear us use these terms and go, okay, it's 1/3 this, 1/3 this, 1/3 this. The industry is not structured that way. It is more accurate to say, generally speaking, something like about 40-45% of the entire financial services industry operates on a commission-only basis, meaning that they're getting paid to sell homeowners insurance or life insurance or disability insurance or banking products or loans or mortgages. And that's fine. That's how the financial industry has been built up over centuries at this point. The next biggest category is going to be fee-based, which is going to be a hybrid of selling products, financial products on commission, or charging fees for service.
Mm-hmm.
And that fee for service could be most typically an investment percentage, right? We're going to manage your investment portfolio for a percentage of your portfolio.
Mm-hmm.
But it could also be project planning. It could be hourly engagements. It could be subscriptions. Like there's plenty of diversity in that universe. But the most common version you're going to see is a advisor or a firm that sells products on commission and manages money as a percentage.
Mm-hmm.
That's going to be 95% of that population. And then there's this tiny segment, and it really is only 2-3% of the industry that is fee only. And fee only is never going to sell you a financial product. They might recommend it to you, but they don't have the licenses, and they're not going to get the licenses to get paid to put that life policy in place. When they do your financial plan and they say you need life insurance, they have no financial incentive to tell you to get life insurance. But they're doing it because they're fiduciaries to you and they have an obligation to tell you what you need. And that means that they with you are then going to have to go to a fee-based or commission-only broker or agent for life insurance to place that product. And that's a partnership. In the same way that same planner might say you need a professional tax preparer or you need a lawyer. So it's having this more impartial financial planner who's not incentivized to sell products or make certain recommendations, who then is turning around and saying, okay, based on my impartial analysis, you need certain financial products or certain professional services, and we're going to help you go get the best versions of those that we can find. And we're not going to be swayed or compensated to put that in place. The last group you mentioned then is a subset of the fee-only universe. And when I say subset, I think there's about 100 of these people around. Like it's a very, very small group. It is growing to its credit, but it's still just it's a subsection of a subsection, and it's the subsection of the smallest subsection. Yeah. But these are people who essentially say, hey, we're fee-only financial planners. We might work on subscription. We might work on projects. We might work on an hourly basis. But the key distinction here is just going to be we do not manage money. Right? We have decided in our business that we want to give you advice, and we might give you investment advice, but we will not manage money for you, period. Hard stop. We won't touch it. And some people are looking for that. I think particularly that DIY type of person who really feels good managing their own money, feels good with their finances, has a great handle on their stuff, and they go but gosh, I really feel like I need a second opinion. I need a professional to just check me, make sure I'm doing a good job. They are going to be very attracted to that model. I know several advice-only planners who are essentially busy all year round on hourly engagements or one-time project engagements because they've built a great brand serving that demographic of that married couple where they're pretty sure they can retire, but they just want a professional double check, and they're willing to pay $10,000, $12,000, $15,000, a lot of money. But but they're comfortable with it because they know in the financial services world it's a lot of money, but a longer term or more ongoing comprehensive relationship where they work with people for years or they have their portfolio placed under management would probably cost them a lot more than that long term. And they would get more value from that, but they don't want it. They don't need to delegate. They don't feel compelled to hand their stuff over or to work with somebody long term. They really just want an expert second opinion before whatever the next phase of their life is. And so again, it's a subsection of a subsection. It's a very small population, but it's growing in popularity. And I think there's certainly a demand for it that is not met by a firm like ours, for example, where we're going to say, look, we'll give you comprehensive advice, but we find it both easier and more effective to do a lot of stuff for our clients. And if you don't want us to do stuff for you, that's going to be a problem. We really just don't have the time and energy to handhold as much as we do to just take care of it for you.
So, I mean, they're obviously as important as any other advisor. So why do you think they're still a subset of a subset of a subset?
I mean, simply put, I think there's a couple of points that go into this. Number one, there is way, way, way more money in being commission only or fee based.
Oh, okay.
I mean, just to give people the scale of it or the idea of it, if I, back in my fee-based days, right, if I put $1 million of somebody's money into a variable annuity product from a company like Lincoln or Jackson National, I could, again, they're investing $1 million. I could get paid $70,000 to do that. right? Or if I help somebody buy a $1 million whole life insurance policy at the age of 35, I could get a commission of $7,000, $8,000, $9,000 just for running a life insurance needs analysis, helping them fill out some paperwork. Yeah. There's a lot of money in the commission universe where just a lot of people do get into the financial services world because you can make really good money. The failure rate is enormous, right? Only about 12% of people survive the financial services world past the first 3 to 5 years. So you can make a lot of money. It's also incredibly hard, incredibly competitive. So all that to then say, the industry as a whole, when you zoom out from the individual level, most of the industry likes making as much money as it can because why wouldn't you to some extent? And they're comfortable with the conflicts of interest that come from getting paid thousands of dollars, tens of thousands of dollars, hundreds of thousands of dollars to place certain products. And again, I want to return to what I said earlier. You need specialists. You need somebody who does nothing but life insurance. You need somebody who does nothing but annuities. Those people are worth their weight in gold, but they tend to make their living by partnering with more impartial fee-only financial planners by being the best resource for us when we have a client who needs what they can sell them, versus going out there and trying to find every single person on earth who would buy the product from them if they could or if they would. So there's just a big difference in those populations. And I don't know that I feel like it answered the other half of that question instead of your question.
No, it answered it. So then you also touched on fee-based. So these are the people who are in the middle of both. So they also sell, but they also care for the client, everybody cares for the client, but in a way that they will put more time into their financial life, the bigger picture. And not just trying to sell something. So they're in the middle. So some people would be asking, wouldn't it be easier to have everything in-house? They might start working with somebody who they trust and over time build that relationship. And if somehow or someday an insurance comes up and they think that it would be adequate for them, is it truly easier or better to only work with that one person?
Oof, that could be a whole podcast on its own, that question right there. I'll give you 3 examples, and maybe that helps illustrate the question here. So the first example is myself. When I started as a financial planner, I didn't start my own firm on day one, but I did start my own practice, and I was a 1099 contractor affiliated with Waddell & Reed, which would be what we'd call a fee-based firm. And, that was my thinking, I can do financial planning, and then I have all the tools possible to solve all the clients' problems. And the trick is that that's not actually true. You think it's true, but it's not true. And the basic example I can give here is, I had the ability to do financial plans. I could charge a fee for that. And then from the financial plan, I could very reasonably ascertain this person should invest money here, over here, in these amounts, in these ways. And I had a fairly large catalog of investments, but Waddell & Reed ultimately made the decision about what that catalog was. By law, not even just by principle, by law, you cannot recommend something your firm doesn't approve of in financial services. Otherwise, you're committing a regulatory infraction called selling away, and you can lose your license. So even something like, hey, you should just invest in some Vanguard funds. I don't think you need to buy a fund from me. Technically, if Vanguard funds are not on your company's menu, you can't recommend that, and you could lose your license for doing that. So that means you're only allowed to recommend the best possible options within the scope of what's available. Now, good news, when I was at Waddell & Reed, there was a pretty broad scope. But even still, you can get paid a fee to build a plan and then get paid commissions or fees to manage their money or to, hey, you need life insurance. Let me go ahead and put that in place for you, and I'll get a commission for doing it. And I think the best version of that is somebody who looks at that and says, and then I'm going to use that to kind of defray costs elsewhere. So I'm going to charge less on investment management, or I'm going to charge less for financial planning because I anticipate you're going to need financial solutions where I will make money kind of in the long term from some other stuff. So if my intent was, made up number here, to make $5,000 from our relationship, but I expect that I'm probably going to make $2,000 a year from investments and insurance stuff for you, then maybe I should only charge you $3,000 for a plan, and then I'm going to make money on the back end. I think that's the generous version of that. The second version of this that I see a lot more evidence of and that I am much less favorable for, and this is a model that I think is very popular at what I'll call the McDonald's of personal finance. I won't name the company, but they're on every corner. The flow is going to look something like this. Come in, let's meet you, and then we are going to present some insurance or investment products, probably on commission. We're going to put buy some investments for you, buy some insurance products for you. We're not going to do a comprehensive plan, or if we do, it's going to be a plan that we could do in like 5 minutes in Excel. It's not going to be fancy or complicated. Mm-hmm. And then we're going to wait a year, 2 years, 3 years, and then we're going to come back. We're going to come back around, and we're going to call up the people that we have worked with in the past. And we're going to say, hey, we want to ensure that we are working with you fairly and consistently. And in reviewing what we did for you a couple of years ago, we definitely recommend all the things we did back then. But now things have changed, life has changed a little bit, and we think it's more appropriate for you to have this. Mm-hmm. And coincidentally, whatever this is now going to be a new commissionable event, or is going to switch from a commission-based relationship to a fee-based relationship. So maybe we sold you some Class A mutual funds. We got paid a 5% commission for that, last year. And now that a year or 2 years have passed, we're suddenly saying, you don't need those anymore. We've got better investments, but they're in this fee-based portfolio program where we're going to get paid 1.5%. To start every year. So we already made 5% up front, and a year later, we're suddenly switching you to something where we're going to make, ongoing revenue. Mm-hmm. That's a much less preferable version. I think that is a much more exploitative version. I also hate to say that is probably the predominant model for a lot of fee-based firms. Not all of them, but the predominant one. Mm-hmm. So then I'll give you my third example, and I'm actually going to name a specific person, a specific firm here. Okay. And the example I'm going to give is Dr. Derek Tharp. Dr. Derek Tharp is a colleague on the academic side. He was actually on my dissertation committee, and he runs a fee-based financial planning practice. Mm-hmm. But very specifically and noteworthy then, that as he does that, and in the way that he does that, he generally charges an investment management fee. He generally does planning at no or low cost, right? Anticipating that he will make money on the investment management side. And the part that makes him fee-based instead of fee-only in that is that he retains his licenses to sell life insurance and disability insurance, because it was his experience that when he tried to refer that out and outsource that a lot of clients wouldn't follow through. They wouldn't get it done. There was friction in that process, and he decided what's in my client's best interest is that I can tell them they need life insurance, they can agree, and I can get it done for them. Mm-hmm. And I think that comes back to the first example, where that's like the all the tools in the belt approach. But I also respect Dr. Tharp's knowledge and expertise and his morals and ethics sufficiently that I'm very confident that he's not doing that because he can make a commission. He's doing it to be more effective for his clients. Mm-hmm. And I think that's the best version of it. Mm-hmm. I personally moved away from scenario 1, and I don't do scenario 3 because I made the determination in my fee-based life that I couldn't be great at everything. Mm-hmm. Like, I could sell life insurance, I could sell disability insurance, and clients need those things, and that's great. But I was not thoroughly enmeshed in the world of life insurance. Okay. Wasn't thoroughly enmeshed in the world of annuities. Wasn't thoroughly enmeshed in the world of disability. Mm-hmm. And so when I needed to recommend that for a client, I do research, but it wasn't my bread and butter. I didn't do it every single day. And so I had to live with this persistent feeling of, gosh, I know this person needs life insurance. I know they need an annuity. I know they need this thing. And I hope I found the right one for them. Mm-hmm. And I don't have a financial incentive to tell somebody else to do it for them, because I'm going to get paid to do it. Mm-hmm. But also, even if I do, I could go back to that selling away problem, where if I said like, oh gosh, I don't think I know the right life insurance for you, why don't we go to this life insurance specialist at a different firm? Mm-hmm. That would be a regulatory violation for me to do that at the time. So it all just comes back to this balance of fee-based has a lot of advantages, but I think there are some ingrained regulatory conflicts and some just general financial conflicts of interest that make it suboptimal as a best outcome. Mm-hmm. And so I think that's just what we have to acknowledge.
Yeah, I think my next question was going to be, why is that fee-based section still so big? And I think the third scenario would kind of explain it a little bit, because some people do need that extra help. Some people don't have the time to be calling 10 different insurance companies and asking them for all their information. Some people just want the papers in front of them and sign them. So that makes sense. It's just the fee base is still such a huge portion of like financial advisors that it's crazy to think like why people still go more for that fee base, knowing that they can find somebody else, and just by doing a little bit of extra outsourcing, they can save a little big chunk of money.
Well, and again, I want to be cautious here. I agree that there can be a lot of conflicts here that cost clients money, and the big reason that it's such a big part of the industry is because they can make, the companies can make a lot of money, and there's a self-fulfilling prophecy here, which is, if I run a company that makes 5 times as much money as my competitor, I'm going to have 5 times the money to deploy to staff, to advertising, to marketing, to lobby, so that the rules don't change on me where I can't do it anymore, et cetera. And I'm going to use those advantages. In the financial services world, the primary lobbyist for that type of business model is an organization called FSI. Donations to FSI are measured in the millions of dollars a year, right? And they spend all that money lobbying to make sure stuff stays the way it is. But the lobbying arm of the Financial Planning Association, or NAPFA, the National Association of Personal Financial Advisors, which tilt more towards financial planning, which tilt more towards fee-only planning, or planning first, solutions, products, etc. second. They don't even scratch the surface on that. They measure their lobbying the donations to their lobbying efforts in the tens of thousands of dollars a year. So you've got something like 20 to 50 times the spend going in the direction of fee-based stuff from a regulatory standpoint and a legislative standpoint, compared to a fee-only offering, even if fee-only might have less conflicts of interest, be net cheaper for clients, and ultimately be better and more in their best interest.
And then going back to the short-term versus long-term, asking for help. I bet you've heard this a lot, where some people can come in and say that they wish they would have started earlier, or they wish that they would have done something different. I feel like financial decisions are also like a snowball effect. It's a ripple effect. Over time, one small thing can become a huge thing. How do you see this happening, or like what are the benefits of finding out what help there is ahead of time?
I think one of the biggest things that people can do to set themselves up for success early in life, or you're 22, you're fresh out of college, it's just, either going out and doing the research, which I'm very skeptical of, not because education is bad, but because there's so much bad information out there. And if you haven't been trained or educated in how to determine which is which, then you could, inadvertently find yourself falling into scams and that sort of stuff. That's not great. But on the other side of it, in terms of how you approach it and how you resolve for that type, and solve for that type of problem, I think it's great for somebody to go to a fee-only or an advice-only plan, or even just like an hourly one, early in their life when they get their first real job, spend a couple $100, $1,000, and just have them sit you down and just tell you, hey, in your situation with your income and with your short, medium, long-term goals, here are the 3 to 5 things you really should do. Right? You should be saving at least this much. You should be managing your money this way. You should be investing this way, just to get pointed in the right direction out of the gate. You don't necessarily need to have a long-term relationship, but it's really helpful to just have an impartial professional tell you, do this, right? Here's for your goals, what you're telling me in your situation, here's where you should go. And then when life gets more complicated, or when you start to have a financial problem that you feel unable to resolve on your own, that is when you want to start exploring the need to, again, revisit that project planner, that hourly planner, or whether you feel like your life is busy enough and complicated enough that you would benefit from a more robust ongoing relationship.
This is also kind of, and we talked about this, but where you go into like a doctor's for a checkup, just for a regular checkup, go for one problem, my head hurts or something, and you come out with 10 different problems. So I guess that's the benefit of going in earlier. But then there's also like robo-advisors, where you can just put in your information somewhere and it'll spit back an answer, and you think that that's the best answer. And again, it goes back to Googling stuff and just falling into traps or things that might not be true.
Well, and I want to parse that or bifurcate your language there just carefully. Robo-advisor typically is going to refer to a firm like a Betterment or a Wealthfront, where you fill out a questionnaire, you open an account, you put money in it, and they're just going to invest it for you. And that's a great low cost, I don't know what I'm doing with investment sort of way to just get your money into the market and know that somebody somewhere is at least doing something for you and you're not just guessing. I think there's a big difference between that and the current sort of AI zeitgeist, where you've got a lot of people coming out there being like, Claude is going to replace financial advisors. Like even the CEO of Anthropic has said Claude is not going to replace financial advisors, because AI has some technical limitations, but also there's a trust and verify factor here, which is how big of a problem does it have to be for AI being wrong for you to say, gosh, this could blow up my entire life. Do I trust this robot's answer to be accurate? Would I risk my life on it? Would I bet my entire financial wealth on it? Versus like, hey, should I buy the Vanguard S&P 500 fund, the BlackRock fund? It's such a distinction without a difference that you could probably just trust AI to tell you what it thinks.
Yeah.
And it's how it came up with that answer almost doesn't matter. But should I save $100 a month versus $1,000 a month? And should I be 100% equity versus 50% equity? Those are going to be multi-million-dollar decisions over a lifetime. And at that point, you have to say, okay, do I trust the free AI ChatGPT to give me the answer on this, or a website or a blog I read sometime? Or do I really want to go to a professional, not only who I know has the education and training to answer this question for me, but also, and this is sort of the thing that you sometimes are buying with a professional, who I can hold liable if they're wrong.
Yeah.
Right? Because if you use the AI, every AI's disclaimer and disclosure thing is going to say, not legal advice, not tax advice, not financial advice, consult a professional. Yeah. And if it goes south, too bad, so sad. Right? Same thing with lawyers, same thing with doctors, same thing with accountants. There comes a time in which you are hiring a professional so that you can blame somebody else when it goes wrong and potentially recover against their incorrectness versus just paying for their advice or the value of their service.
Ask me the question.
Ask you the question. That was sudden exciting. Anahi, what have you learned in the last week or two that you feel like our audience would benefit from hearing about?
I learned about the MOOP.
The MOOP? Okay.
You're going to go again with my funny terms. But this past week, I learned about how to identify what is the most someone would have to pay out of pocket before insurance kicks in. So I think the MOOP, the terms of the MOOP is the maximum out of pocket. So it is what the term is. So one of the most important things to look at is one of the most important things to look at when somebody is worried or don't know how much they're going to be liable in case of an emergency happens. So it basically gives you a limit, and you know that limit is the absolute most that you would end up paying before insurance comes in and then pays for the rest. That is covered, obviously. So after the deductible, after the co-payments or co-insurance, if it is there. So basically it gives you an idea of the max that somebody would have to be liable for, and I think it is especially a safe way to know how to budget and know what to budget for emergencies like healthcare.
Sure. And I gotta ask, you absolutely knew what that was beforehand. You just really wanted to say MOOP on the podcast.
I wanted to say MOOP.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.